Welcome to New Home Insights, the podcast from John Burns Research Consulting. I'm your host, Dean Worley. If you want to follow market trends, demographics, capital, new ideas, and endeavors that touch on housing, we're going to try to make sense of that every couple of weeks. Let's go. Hi, everyone. This is the New Home Insights podcast with your usual host, Dean Worley. Today, though, we bring you a fireside chat that John Burns, the guy with his name on the company logo, conducted with Don Mullen at our Rental Communities Summit. Don is the CEO of Pretium, as a real estate-oriented investment firm with a focus on single-family rental assets. Pretium is the parent of Progress Residential, one of the largest SFR owners in the nation. That's not all Pretium does, though, but I will let Don and John talk about the world of SFR, the fix and flip space, home remodeling, as well as the present and future of the build-to-rent sector. Enjoy.
Well, one of the beauties of having a virtual conference is that you can schedule crazy busy people like Don Mullen to find 30 minutes in his day to talk to us. So thank you so much, Don. We had a kickoff call so I got another 30 minutes with Don, so I'm super privileged. He's the founder and CEO of Pretium. We met when he was still at Goldman, right before he was thinking of doing this in early 2012. Pretium is the parent company to Progress Residential, which last count I saw was 97,000 homes. There's probably more than that now. They're managing homes for others as well, which he'll talk about. Prior to doing this, he was the head of global credit and mortgages at Goldman and a member of the management committee there, right at the top. Your website says 52 billion AUM, but that was a year ago, so I'm assuming it's more than that now, because I also know you just raised $1.5 billion that you're ready to deploy. And the other platforms include stressed home loans, non-agency mortgage originations. He's got a really strong mortgage background, which we'll talk about that a little bit too. And he's getting into home builder finance and repair and remodeling finance, actually, too. And our good friend Brendan Brosman is going to be joining him soon to run one of those. So hopefully I got everything there, Don. Well, just what matters. There's a lot more. Let's get started.
You touched on the things relevant to today. So
okay,
that's what's important.
Let's start with a little background. I mean, when you spoke at our New York Housing Outlook a few years ago, you used some great terms about snowflakes and cash flows. And I just want you to talk about the evolution of the SFR industry since you've been at it from the ground up, because you were at the mortgage-backed securities market from the ground up too. And what did you learn about that, and what are the parallels? And then, SFR feels a little more mature today. Where does the SFR business go from here?
That's quite a broad question. We could wax eloquently for the whole time on that one topic. Well, first, let me say that the analogy to the mortgage-backed securities market is really quite interesting, because what we did in securitization, going all the way back to the 80s, is we took small objects, securitized them for the purpose of making them very investable by institutions. So whether it was taking mortgages off the balance sheets of banks, eventually, obviously, we're taking commercial real estate loans, then consumer loans, i.e. credit cards, auto loans, and the whole industry securitized and made that kind of credit access for investors much more readily investable and tradable. What's interesting now, and at the risk of digression, I'll do this quickly, is we're actually running that in reverse to some degree. Oh. And what I mean by that is the advancement in technology in the 80s allowed us to be in a position that we could track and service securitized small bits. Now, because we have such advances in technology, we can actually take those small bits and investors can directly invest in them. So if you think about what our platform does, right? We have 97,000 homes. We have them in funds. But we also have them on the balance sheet of insurance companies, sovereign wealth funds, and pension plans. So those organizations that 15 years ago needed to invest in a securitization can now directly invest in those assets and choose what kind of leverage they want on them and the manner with which we manage them. But that's not the only thing we do that with. Anchor loans that you mentioned, We're putting RTLs on the balance sheets of insurance companies and others. We're putting home builder loans directly on the balance sheets, non-QM mortgages directly on the balance sheets. And so what's interesting is the technology first step in the 80s that allowed us to create large pools of fragmented assets and securitize them at this delivery. The advancements of technology now is to let those actual fragmented assets in scale. So for us, our $52 billion is a lot of those fragmented assets, not always in funds, but on the balance sheets of sovereign wealth funds, pension plans, and insurance companies. And that's really a radical change from even where we were in 2008.
Yeah. RTL is a relatively new term to the industry. Can you explain to everybody what that is?
Sure. Well, anytime we try to go institutional with something, which I'm sure everyone here in this conference is well aware of, you have to dress the moniker up. So fix and flip was not really a good term for institutionalization, but RTLs is a much better end. So residential transition loans is last year's fix and flip loans.
All right, we do a fix and flip survey. I may have to rename it. So thank you for that one. Well, you also believe in going big in a deep specialization, as opposed to some of the other capital partners who've been on here and some of the other big Wall Street groups that diversify across all sorts of asset classes, outside and inside real estate, but even in real estate. Can you talk about your specialization in housing and what that's allowed to build you from a tech standpoint and the competitive advantages you have because of that?
Sure. So yes, we have what we like to think of as a broad residential ecosystem. So as I effectively listed some of our team, there's more. We originate non-QM mortgages. We buy single family homes. We make home builder loans. For this conference, I'll use the word fix and flip again at your recommendation. We make fix and flip loans, right? We service loans, both performing and non-performing. And that ecosystem creates a tremendous amount of data. So as we began our process to do home builder loans, one of the things that was very available to us was to look at a town or a city, rather, like Jacksonville, and look at a project in Jacksonville. And then we could populate that map with all the assets we already own in that community, all the assets that we track from our renter peers, all the houses that we looked at for purchase. And we could build this heat map that informed us without calling a single person, without asking for a single AVM, without calling a local person at all. Relative to the builder's plan, how does the sound check, the first sound check work versus what we know about that community and all the adjacencies we have? And the reason I bring that up, it's just one of hundreds of adjacencies that we believe we create. So since you like snowflakes so much and snow, the metaphor that I use for this one is wheels. When we started the business in single family rental, it was like a single stone wheel. As we started to build out our business, we've now become a wagon wheel with several spokes to our wheel. Our aspiration is to create a bicycle wheel, right? And that's one of the reasons we bought BH Management. So being in a position that multifamily in the same communities we're in, we think that it can be a catalytic, energetic combination between Progress and BH to really, take technology and operating efficiency up to a new level in those communities to better serve both our investors and our residents.
So just to drill one point home, a little bit more that you just made. So in addition to all the publicly available data that is out there that you could load up and have in your database, you've got a lot of proprietary data now too. You know the debt to income ratios on all 97,000 tenants. You know their credit scores. You know a lot more about a neighborhood in Jacksonville than anybody I know. And so
Sure.
Can you talk about what that allows you to do from an investment standpoint, and the speed associated with it and the confidence?
Sure. So I'd say speed is a really important concept there. So we try to work very closely with and view ourselves as a partner with home builders. And we like to think of ourselves as a helpful partner in inventory balancing. So if there's challenges during a quarter because of interest rate volatility, or just they want to turn capital more quickly, we're a very constructive partner. Obviously, we have return goals, just as they do. We try to work together to find a path that achieves both our goals. But our data allows us to respond very promptly when a community comes up or a part of a community comes up for sale. So we will get lists of communities and individual homes. And we're happy to buy either. But the data that we have in the communities we operate in allows us to look at, literally thousands of houses and or communities and respond within 24 hours about what we want to buy without any external data.
Let's bring that home a little bit more too, and talk about closing. So if I'm a home builder and it's, I'm a public home builder, the stress tends to come around quarter end. So I'm getting near quarter end. I've got 10 communities maybe that aren't selling very well. I've got another 5 homes over here that I'd be willing to sell them to you, and I can send you the information. How long would it take you to do your analysis, and then how long would it even take you to close?
Well, we all like to call them data tapes. So I'm not sure anyone's seen anything but Scotch tape in about 20 years. But someone will send.
I actually worked with tapes before Excel files. That's all I am.
I hear you, but you have hair, so that would imply that I beat you.
It's gray.
With that being said, obviously someone will communicate data with us, probably a data room, but we'll be able to run that through our algorithms to determine the rentability of the asset. And we can be responsive depending on the scale of the files we're looking at within a couple of hours to 24 hours and begin the process of discussion. On closings, one of the things that we have is a big advantage. We've always run a very large closing department where we can close not on the pool, but on individual houses. And that's something that we can also accomplish super quickly. So people have called us as recently as within 2 weeks at the end of the quarter, and we've gotten things done for them. So it's very, very dual. And could we compress time even more? Yes, we certainly could.
So this has been a thesis of Don and mine from day one, was that if the market ever got soft for the home builders, there's this new category of buyers that really would help a builder during a downturn unload some inventory. And you're playing that out right now that you're already doing that. Is that part of the recent fundraising that you're doing, that you're going to be doing more of that, do you think? Or maybe you could talk about some of the other platforms that you're looking to grow in.
Sure. Well, we've raised $1.5 billion of equity, which puts us in a position that we at least accomplish $3 or $3.5 billion of purchases in this space and balancing that inventory for home builders. And so we continue to see that as a very attractive partnership between ourselves and many home builders. As we talk about that, the way we think about the dislocation that's gone on with the loss of First Republic Signature and Silicon Valley Bank, we're very much of the view that was the beginning of a process, not the end, a slow grinding reduction of the role and presence of regional banks. So we have, as we talked about, begun a process of home builder lending, but also lot lending, development lending as a part of building out our ecosystem. So we think of ourselves as even more of a strategic partner on the go forward than we were when we started our BTR process. And so you should continue to see us building out my metaphoric bicycle wheel, where we're going to occupy more spokes where we probably will never build houses, but we may be a land partner with home builders. Well, certainly if we are operating third-party property management on BTR communities through BH. I think growing third-party property management overall, and I think the Invitation Homes guys have done a great job. I think that's an important part of making the asset more liquid. So as you imagine where we will go from here is we would expect that our home builder lending business will be a very meaningful chunk of what we're already doing. So again, think of it as $30 billion of houses, $15 billion of resi credit. Imagine we'll be at $15 billion of home builder lending pretty quickly. And at the same time, as I suggested, we'd be buying, $3 to $4 billion worth of homes from home builders over the intermediate term. So we're very excited about that. And we're very excited about how to be more effective at managing communities for both our investors, but also third parties using the BH platform.
So I know you're very entrepreneurial, and you're not getting into this just doing the same thing everybody else is doing. So could you do a little bit more on that? And like, how would your construction lending platform a little bit different? And is this land banking you're getting into as well, but kind of a different twist on it?
Well, yeah, as you mentioned, we've hired one of the friends of John Burns to join our team. The way we look at this is a movement of all of those attributes out of the banking system into private credit. The right analogy in our mind is private credit. Less so is it real estate debt as we currently know it. And the reason why we think about it that way is that a little bit less, certainly less securitization, more all in fund form, with an investor base that wants some modest leverage, not CLO type leverage or CRE type leverage on it, and looking for reasonable returns. I frankly think it's much more attractive for the economy overall, because banks have a different liability structure that seems, as we saw last year, can leave very quickly and leave loans in bad shape, and they have much more leverage. So this is locked up equity capital with modest leverage that will work, again, all the way from land banking, all the way to vertical construction, when we expect, again, to see a increasing amounts of global demand, literally global demand for home builder finance. And we've seen that our partners to date are stretch all the way from pension plans in Australia to sovereign wealth funds to state funds in the United States. So I think this is the beginning of a wave, and we're very excited to have the opportunity to participate in it. Our place in the market, though, will not be lending money to Lennar. That doesn't mean Lennar isn't a wonderful company or a good bunch of folks. It's just that they have plenty of people who want to lend the money. It's the home builder that needs between $5 and $25 million that's really going to struggle as this cycle of banking devolves. And so we think our effective role for both that home builder or land development team and our investors is to focus on that category, which, while it may not be as fragmented as a $376,000 loan, it's still fragmented banking terms wise. And that's what we are. We specialize in the implementation of technology for the purpose of taking fragmented assets and turning them into investable assets without losing the return that you can get by securitizing. That's a long-winded homily about the firm, but
and that was the construction lending. But is there a long-term land development financing platform here too?
We're looking at that today. We'll definitely be doing lot financing now, but I like to look at things that have dislocations, and there seems to be more than a modest amount of land that's looking for someone to help facilitate both ownership and finance. So you would expect to see us there maybe as soon as our next video call next year. Okay.
And then one other opportunity that I think is relevant here, because we've been talking about construction costs, and one part of our business that has grown the last 10 years or so is our building products clients. And that's taken us into the repair and remodeling industry, which is kind of lagging right now because people aren't doing refinances, obviously, to get the cash for a remodel, and HELOCs haven't really taken off. So you mentioned you look at areas that are not working very well, and there's an opportunity. Is that an opportunity too, to do repair, to help the repair and remodeling business grow again?
Well, to some degree, if you think the fix and flip business is in an intergenerational repair and remodeling business, right?
Yeah.
Often you're buying an asset from, right. And this is even more so today than ever before. So if you look at home ownership and you go back to 1990, and I'm sure you've seen this chart since you're far more knowledgeable than I am about this. There used to be a nice big curve at 60 years old. Mm-hmm. And people used to sell their homes. And now people are staying in their houses till they're 75 to 80. So those houses will need even more renovation when they eventually become for sale. So we see that working its way as sort of, it may not be the pig through the snake, but it's certainly the guinea pig going through the snake. In addition to that, I agree with you. One of the most attractive areas that both as a lender and at a catalyst is home equity that's embedded in people's homes today.
Right.
It's huge. Right now, the challenge is most of the big banks don't have the technology or the desire, because of the poor cap charges, to run a home equity strategy. Closed-end seconds people like doing, but borrowers are less enthusiastic about closed-end seconds because that means you're borrowing all of it at once and then doing it. So finding that middle road, I think, will be important. But yes, we're working very hard. We're very active in closed-end seconds and working on trying to be as effective or efficient in home equity. Because again, great investment. And I think it helps facilitate the renovation business that you're talking about. I would expect to see more, though, quite frankly, as rates come down. I think we live in this sort of state of unexpected events occurring. And I'm not talking about the presidential election when I say that, but rather I'm talking about if we sat here in 2019 and you and I were discussing a pandemic, right, that might have a large volume of Americans pass away, we'd probably be talking about home prices going down. Mm-hmm. Instead, they went straight up. Then we had this rapid increase in interest rates, right, at the end of the cycle. And what interest rates usually go up like that, we're like, well, home prices are going to come down. And they didn't. We destroyed more supply than we destroyed demand. So let me just postulate the unusual outcome of lower interest rates. Is it possible that lower interest rates could put us in a position that it slows down home prices?
Well, one of the CEOs at our conference in the homebuilder CEOs at our conference at the Montage in May said he doesn't want rates to come down because he likes having no resale competition.
Correct.
So there you go.
I'm with him for his description. For me, I made my first 50,000 houses one at a time off the MLS, and the MLS is now the most expensive house, right? So buying portfolios, working with home builders gives us more high quality investable assets. But yeah, I believe he's right. What we're going to see with lower interest rates, more homes that are owner occupants selling. We've already seen like a 30% jump in that, but I expect more to come, is that people should be ready for that. Declining interest rates will create a better balance between homes for sale, right, and supply demand. So better balance between supply and demand. And to answer your initial question, which I apologize for digressing from, I think will improve renovations pretty significantly because so many of those homes will be renovated by the new buyer. Yeah. Or have to be renovated for sale to some degree. So I think building supply demand should increase as rates come down.
Okay, that's super helpful because a lot of people on our call care about construction costs.
Sure. Sorry for being long-winded again.
No. We left 30 minutes here because I learn every minute you talk. Can you tell us about what you just raised $1.5 billion? So you've actually done it. We were talking about capital markets earlier. Can you tell us how the capital markets are today versus maybe a few years ago, and what are they looking for?
Well, there's a big difference between debt and equity markets. Obviously, the equity market was very, very challenging, and so raising the $1.5 billion, the beginning of the journey was very choppy, needless to say, because everybody was wondering what their real estate portfolio looked like, because they couldn't, if you were talking to a large allocator, office was in one place, there was dire predictions for multifamily. So there was a lot of uncertainty. And as a result, returns had to be either much higher or people were more focused on debt. I think we're seeing the return that our success in fundraising is a sign of the return of interest in equity for real estate. I think it's also at the same time, the debt markets, separate and apart from our securitizations, which go into institutions, but our home building debt, as an example, one of the clients we work with allocated $3 billion in 1 week globally in real estate debt for low to mid-teens, because when they look at relative value around the planet, they'd rather get a 14 from debt than try to get a 18 from equity. And I don't think that's an unwise allocation. In fact, I would give them credit for being very thoughtful, both domestically here in the US and globally. So capital markets first, let's say that they're liquid, they're functioning, and spreads are coming down on securitizations for our single family homes. So that's good for us. I'd also say that we're in a position today that on the channel side, one of the things that we find most exciting after the partnering with our home builder colleagues is the consolidation we see taking place in single family rentals. So a lot of the tourists, we like to call it in my trading desk back at Goldman Sachs, folks who enter markets when it gets very frothy, are leaving single family rentals, now understanding the complexity of managing them. And as a result, both ourselves and others are seeing great opportunities for acquisitions. As recently as 6 months ago, I would tell you that I was bidding on portfolios and I might have been the only one bidding. And now, even though my team is extremely disappointed that recent bids we've made, we've been topped, I see that as a really healthy sign for the marketplace. And so as a result, that to me tells me there's more equity coming back. There's more healthy competition. And so that makes me feel very optimistic about where we are in the cycle for single family rentals. I'd also like to give a shout out again to Invitation Homes. I think one of the most important things that's taken place is them making a really big push into third-party property management. And there really hasn't been a platform of their quality that's really been committed to third-party property management. And I think that improves the liquidity in the markets quite dramatically. And I think others will do the same because it helps all of us. And so the combination of relative stability in interest rates, equity capital coming back, consolidation on its way, spreads coming down, I expect to see a robust single family rental market for the next 12 to 24 months again. That doesn't mean house prices going up,
Right.
just lots of transactions and financing.
Well, I could talk all day. We only got 2 to 3 minutes left, so I'll leave with probably the most pertinent question for the theme of this today is, well, what are your views on building rental communities today and over the long term?
I think that it's one of the most effective ways that we can help create housing stock in America, since there is a large cohort of Americans still that cannot afford homes at current prices, but can rent those houses. And so I believe it's one of the fastest ways to build enough product and infrastructure in communities where housing is needed. We as a country need a rent-to-own product.
Yeah.
Because we are not going to solve the housing challenges we face where there's only an 80 LTV product where people have to go borrow money from their grandma or their grandpa, and we're not going to get anything solved. And I think the SFR industry can be a bridge, not just helping people improve their credit scores, which we and others do, working to report positive credit performance, but also being in a position that we find a product that helps people graduate from rentership to ownership. And so I think those rental communities are an important part of that solution.
Yeah, no, I couldn't agree more. Well, thank you very much for your time, Don. I think I took 4 pages of notes here while I was interviewing you at the same time. So I loved it. You helped me a lot with the summary.
Thank you so much.
Okay.
Bye.
Thanks for listening to John Burns talk with Don Mullen of Pretium. Next episode, we have something we hope is very special for you. John himself is going to come on and talk about the future of housing for our 100th episode of the New Home Insights podcast. We'll hope you enjoyed that next time.